Hello, traders. My name is Kevin McMillan. I've been trading for a long time, and I've seen a lot of things online and in YouTube, books, and other areas that completely misrepresent what the meaning of risk is when you're a trader. I would appreciate it that you watch this video rather than jump away. It's not that long, and you may actually learn something that surprises you. I'm going to go ahead and read this. You have the option of muting it and moving the video around and reading it yourself. However, I'm going to read it for those that may have trouble focusing and or reading. All right, number one, managing risk. A few important warnings. Most traders are taught to manage the risk of each trade separately from the risk of their overall account. That sounds reasonable, but it hides a deeper truth. Risk is not something you set. It's something you create through your decisions. Before you can manage risk, you must understand what it actually is, how it behaves, and how it interacts with your psychology. Without that foundation, every rule you follow becomes a superstition rather than a strategy. Number two, risk to reward ratio. The risk to reward ratio is often presented as a magic formula, a simple 1-to-2 ratio that supposedly guarantees long-term success. But this idea collapses under scrutiny. Price does not move in fixed increments, and market structure does not care about your ratio. When traders force a 1-to-2 target onto a chart, they're not measuring risk, they are inventing it. And it doesn't matter whether it's a 1-to-2 ratio or 1-to-3. It's the same thing. It has no different meaning other than the fact that you're inventing it. This creates an illusion of control. The trader believes they are being disciplined, but in reality, they are anchoring their expectation to arbitrary distances on a chart. The result is predictable: inconsistency, frustration, and eventually the belief that trading doesn't work. If risk is going to guide your decisions, it must be objective, measurable, and grounded in how markets actually behave, not in formulas repeated by the herd. Number three, account risk percent. The advice, and this is critical, everybody get this one, the advice to risk 1% or 2% of your account per trade is one of the most repeated and least examined rules in retail trading. On the surface, it sounds prudent, but think about what it really means. If you risk 2%, you are risking double the amount you would at 1%. That's not a small difference. It's 100% difference in exposure. So what are you going to follow? 1 or 2? Because those are totally different things completely. More importantly, this rule assumes you can control your losses, but you don't control risk. You control your exit. We don't really control risk. Our exit is what we control. The market decides the rest. A stop loss is not a guarantee, it's a request. Slippage, volatility gaps, and liquidity all determine whether your risk, 1% risk, is actually 1% or something far larger. Risk only becomes real when you choose to close a position. Until then, it's nothing more than potential energy, a possibility you have chosen to allow into your account. Really think about that one for a minute. 1% or 2%. Amazing. All right, number 4, the only objective risk. There's only one risk that is not subjective, not theoretical, and not negotiable: the possibility of a total loss of all positions. This is the true worst-case scenario, and it may feel extreme, but it is the only risk that is mathematically absolute. Every other form of risk, stop-loss distance, percentage per trade, reward targets, is a human invention layered on top of this fundamental truth. Understanding this doesn't mean you expect all your positions to go to zero. It means you recognize that risk is not a number, it is an exposure. And exposure compounds across positions, across time, and across your emotional decisions. Number 5. So how do we use risk correctly? If risk is not a formula, not a percentage, and not a ratio, then how should a trader use it? The answer begins with redefining risk as something structural, not emotional. Risk must be tied to the behavior of the market, not the comfort level of the trader. It must be measurable, repeatable, and independent of personal bias. Number 6, using risk correctly. The truth, most traders never learn. The first step in using risk correctly is accepting that risk is not a tool, it is a consequence. It is not something you set with a stop loss or a percentage. It is something you create through the structure of your decisions. Once you understand that, the entire concept of risk transforms from fear-based restraint into structural reality you can design around. Most traders try to manage risk emotionally. They place stops where they feel uncomfortable. They size positions on fear. They exit trades because the red number on the screen becomes too loud. This is not risk management, it is risk reaction. To use risk correctly, you must remove emotion from the equation entirely. That begins with a simple but uncomfortable truth. Risk is only dangerous when you attach it to poor decisions. I'm going to read that one more time. Risk is only dangerous when you attach it to poor decisions. So the reason a lot of traders incur a problem with risk is because their decisions, the equity that they're investing into, the option that they're buying, those decisions are not based on really solid proof. They're based typically on the preponderance of the things that are readily available on the net. And because it's readily available, it will rarely be accurate. All right, let's go on. A stop loss does not protect you from bad decisions, it confirms them. A percentage-based rule does not reduce exposure. It simply reduces your confidence. A risk-reward ratio does not create consistency. It creates false expectation. Risk becomes manageable only when you become structural, not emotional. Structural risk means you trade only high quality assets. You allow time to work in your favor. You eliminate the need for forced exits. You avoid overconcentration. You build a system that does not require your constant presence. When risk is structural, it becomes predictable. When it is emotional, it becomes chaos. The market does not punish traders because they risk or take risk. It punishes them because they take the wrong kind of risk. The kind created by impatience, by following the herd, by trading low quality assets, or by relying on tools that were never designed to produce consistent results. The correct use of risk is not to reduce it, it is to neutralize it through quality structure and time. When you trade only the strongest asset, when you divide your capital intelligently, when you allow compounding to do the heavy lifting, risk stops being a threat and becomes a background condition. Something acknowledged but no longer feared. This is a problem with traders. They're constantly in fear of risk. I don't trade with fear of risk anymore. I overcame that a long time ago. Let me go on. This is why you can place a trade and walk away. This is why you can go to a movie, take a walk, or let a position set for months. You are not avoiding risk, you have designed it out of your process. And this leads to the final uncomfortable truth that most traders never accept. Risk, as taught to retail traders, is a poison pill. It is sold as protection, but it functions as a limitation. It is marked as discipline, but it creates inconsistency. It is presented as wisdom, but it destroys accounts slowly and quietly. The size and quantity of your position matters far more than any stop loss ever will. Quality matters more than than any risk to reward ratio. Time matters more than any percentage rule. When you stop treating risk as a fear to be controlled and start treating it as a structural element to be designed, your entire trading life changes. You stop fighting the market, you stop fighting yourself, you stop bleeding from 1,000 small cuts. You begin to trade with clarity, patience, and purpose. And for the first time, risk becomes what it should have been all along, a non-factor. All right, this is some risk in my interpretation. And all I'm saying is that a risk doesn't exist, right? It's not something we set, right? It's something we create and we attach to our trade to cause us problems. And you should read this on your own, try to understand it. And please feel free to ask questions, because once you understand this, you'll begin to change everything you do about trading. So later, stay green.